Hi, let's work on the Ball Company question. So we have 9% bonds dated October 1st, 2016 with a face amount of 200,000, and these were sold for 205,294.53 to yield 8.6%. So the stated rate on the bond is 9%. We need to do the first requirement. We do this journal entries using effective interest rate method. So let's get started on first recording the sale of the bond. So when we sell it, we receive cash $205,000 and $294.53, and with that we have a bond payable of $200,000 and the remaining amount is premium. So bond payable is $200,000 and premium on bond payable is the difference. So we take 200,000 subtracted from 205,294.53. So we have 5,294.53 to be our premium. In December, assuming we have a December closing date, we need to accrue interest for the 3 months since October 1st. So the interest expense for December is equals to the last carrying value. So we take the 205,294 times the yield rate times 8.6% times 3/12. So 205,294.53 times 8.6 times 3/12, we get 4,413.83. The reason we're doing 3/12 is because of the 3 months for the for this year, for 2016. So this journal entry is taking place on 12/31/2016. We have an interest payable. The interest payable is based on the terms specified on the bond. So the terms are that the bond has a face value of 200,000. So we're going to have 200,000 times the stated rate of 9% times 3/12 for the 3 months. So that gives us 4,500. So we have interest payable 4,500. The difference between those two numbers is $86.17. So that's our amortization for premium. So premium on bond payable gets amortized by $86. So premium on bond payable $86.17. In March, so this bond is being paid in March, every March and September 30th. So on 3/31/2017, we have our first payment. So first let's figure out the interest expense. That's our last carrying value, which we had this as 205. By then we have not amortized, we are amortizing it for the first time right now. So times the yield rate, 8.6% times 3/12. The 3/12 is January, February, March. So we have that calculation there is going to yield the interest, give us the interest expense for the March 31st. So we have interest expense as 4,413.83. We settle, at this point we pay out the interest. So we settle this 4,500. So we close out interest payable 4,500. And in addition to that, we already stated that we have a cash outflow for the entire interest for 6 months. So the 6 months of interest, so 200,000 times 9% times 6/12. So we're going to pay 9,000 the difference between the 9,000 and these two figures is our amount for the amortization. So the amortization amount is the difference between the 9,000 and the total of these two. So we get a total of $86.17 as our amortization for premium. So premium on bond payable gets decreased by $86.17. Come September, we make another payment. So on September 30th, 2017, we have an interest expense. And the interest expense, again, we repeat, we use the last carrying value. At this time, we're no longer using 205, 294.53. The interest expense is going to be 205, 294.53. We subtract the 86 that we already amortized. Actually, we have two of them that we've amortized. So we'll subtract 86.17, subtract another 86.17, which is resulting after that. And we're going to multiply this times the yield rate, so 8.6%, and times 6 months, so 6/12. So that's how we are getting our interest expense. So our interest expense is going to be $8,820.25. We make another cash payment of $9,000. The difference between the $9,000 and the interest expense is our amortization for the premium. So premium on bond payable gets decreased again by $179.75. We have on December, the end of the year, we need to accrue interest for the 3 months. So 12/31/17. Let's accrue interest for the 3 months. So interest expense, we have that as our last carrying value times the yield rate times 3/12, so 4406.26. And we have interest payable doesn't change. It's based on the 200,000 times the stated rate, the 9%, and times 3/12, so 4,500. The difference between those two, that's 93.74, is our premium on bond payable. We have premium on bond payable of 93.74. So this is the reduction in premium from this round. Next, we're going to do the straight line method. Okay, so continuing with the next part where we're doing the straight line amortization. So with the straight line, the first transaction does not change. So we still have that recording for the issuance of the bond. So we received the cash and we have a bond payable of $200,000 and premium for the extra $5,294.53. Let's record the December 31st. So 12/31/2016, we need to accrue the interest for 3 months. So first of all, let's work on what we need. We need to start with the interest payable first, which for the interest payable, it's same as when we did under the effective interest rate method. So that's 9% times 200,000 times 3/12. That's our 9,000, 3/12 in this case, not 6 months, so we just have 4,500 of it. In addition, we do have premium on bond payable. So we start with the premium on bond payable. So premium on bond payable, we can compute that because we're using straight line. We have a total premium of 5,294.53. To get the one for 1 year, so this bond has a 10-year life. So we divide it by 10, we can get the yearly amortization. But for this first one, we just need 3 months. So we'll do times 3 over 12. So that's going to result in $132.36. So that's the amortization for 3 months. So premium on bond payable is $132.36. So again, just a reiteration that when we're doing straight line, we figure out the amortization and the interest payable or the payment itself. And then the interest expense is a derived number. So interest expense is the result of the other two. So we're going to net this against that to get the interest expense, which is going to be $4,367.64. So it is derived from the interest payable, or if it was a payment date, it would be the cash minus the amortization for the bond. Next, let's work on March 31st, 2017. So again, we have 3 months for this one, January through March of 2017. Our interest expense is derived, and interest payable. So for the interest payable, we are settling this, the one from this time. Remember that in March, the information is that we are paying in March and September. So in March, we are settling that $4,500. So $4,500 gets settled this time. We do have the premium on bond payable. Since we are doing straight line amortization, we're going to do this, except this time again is 3 months, January through March. So it's still $132.36. So we have $132.36. We have cash payment. That is 11% times 200,000 times 6 over 12. Times 3 over 12, sorry, because that's March. So times 3 over 12. No, actually, even though we have 3 months this year, we're paying all the money for last year's 3 months and this year's 3 months. So we have a total of 6 months to pay, rather. So 6 over 12 because of 6 months from last October until this March. So we are paying out $9,000 in cash. We pay out $9,000 in cash. We have a bond payable $132. We have $4,500 of interest payable. The difference is our interest expense. So again, this is our derived number when we're doing straight line amortization. So it's $4,367.64, which is the same number that we have up there. So it doesn't change. So these two, they are the same. We have them over and over. Whenever we have 3 months, we have that. Now let's move on to September 30th. So on 9/30/17, we have another 6-month payment on September. So interest expense again is a derived number. So let's leave that for a minute. And we have premium on bond payable. The premium on bond payable, this time we're doing the same premium divided by 10 is for the 10 years, but we'll do 6 over 12. So instead of 132, we now have $264.73. Approximately, it's off. It might be off by a few, maybe a cent or two because of rounding. So we have premium on bond payable $132,036, and at this point we pay out cash. Actually, sorry, the premium on bond payable, sorry, is 264. So the 264.73. We pay out cash 9,000. So we're paying for the 6 months from March 31st to September 31st. So we settle that, and the interest expense is our derived number. So we take that and subtract 264.73. Now we have interest expense being 8,735.27. And lastly, we do December's journal entry to accrue interest. So December 31st, 17, interest expense again is a derived number. So let's leave that for a moment. We'll work on the premium on bond payable, and this is for 3 months since September 31st to December. So we are back to 132.36. So we have 132.36 cents for the amortization for premium. Interest payable for the accrued for this year, we have 4,500 for the 3 months, and the interest expense is a derived number. So we have this being similar to December last year. So we have 4,000 for the expense, 4,367.64 cents, which is the difference between the 4,500 and the $132.36. And so the description is to accrue interest for the 3 months from September 31st to the end of the year. So that's it for the requirements in this question.